Welcome to TheoTrade. This is Don Kaufman, December 29th, 2021. 10 minutes left inside of today's trading session with the S&Ps just riding on the upper edge of this week's expected move. And frankly speaking, the entire trading week comes down to the edge of that expected move. That and much more here on this evening's update. Let's start, of course, inside of the SPX and give you a little bit more detail of kind of what it means to be, riding on the upper edge of the expected move. So each and every week, we actually kind of define what the option market depicts risk to be for the week. So this is, of course, the SPX. The expected move is equivalent to plus or minus roughly 72.40 this week. So what we were looking for is a $72 move higher or a $72 move lower. So what happened pretty much out of the gate, of course, on Monday is, well, we rocketed right to the upper edge of the expected move. Then subsequently, where are we right now? Okay, so now I've actually taken us into an intraday, 1 day, 1 minute chart. And again, the entire week, we're just skirting the line around the edge of the expected move. Nothing to see here. The edge of that expected move is sitting just shy of the 4,800 level, as it pertains, of course, to the SPX. Now, the remainder of the week, you're looking for this, looking for some volatility. Possibly, are we going to get any? The SPX is still presenting, if you will, only about a 9.7 vol for the remainder of the week at a $32 expected move, which is categorically speaking, it's a little bit light. However, there is a little bit of a cause for concern, if you will. One of the things that you have to keep in mind when you're on the upper edge of this expected move, the expected move is kind of the happy place, if you will, between, of course, buyers and sellers. Right? If you looked at the expected move, that $72 is almost like an average. If you were to go out and you were to sell premium, okay, the average premium sold throughout the option chain would be about $72. Conversely, if somebody was on the buy side of that premium, it would be about $72 and change. So right here at the upper edge of that expected move is almost a seam inside of the risk. And what you need to be aware of and cautious of at any point, throughout the course of this, the remainder of this week, of course, Thursday, Friday, if we start to propagate a little bit of gains away from this, roughly speaking, if we get up to SPX about 48.10, okay, we could actually accelerate to the upside. And that would be, in effect, a bit of a gamma squeeze. Why would that occur? As soon as we get outside the expected move, all right, that'll actually kick on market making servers to buy. Why? They're going to have to buy to hedge off any short gamma they may have, right? That short gamma really starts to kick in a high gear. In effect, what happens is as we go up and up and up, their positions, market making positions, get monstrously negative delta. To offset the negative delta, they add positive delta to mitigate their directional risk. Where does the positive delta come from? Right here inside of the S&P futures. So again, above 48.10, we can really start to accelerate to the upside. On the flip side of that, though, and again, you have to look at this. This is neither bullish nor bearish. When you start looking at this seam in the marketplace, we start to head a little lower, and we can start to project a bit lower from that as well. Nevertheless, the real risk at any time that you're at the upper edge of an expected move like this, that move can, in fact, accelerate to the upside, and things can get downright wild, if you will, to the upside. Another aspect worth noting over here, the marketplace just the last couple of days, once again, is Skew-tacular. What does that mean? Well, when I pull up the symbol Skew, you see absolutely nothing because Skew is calculated at the end of the day. You got to come over here from, change it from a candle over to like an area, right? So Skew, once again, is rocking to the upside, which is making it, well, once again, we're up to a 153 Skew. I want to bring this up for, well, the maximum chart. Skew inside of the SPX, they started calculating it all the way back here, 2011, 2012 timeframe, right? If you look back through time, this was kind of the upper edge of Skew, if you will, like, 125. We're like 153. We're trading like Never Never Land, which what this in effect does is it makes out of the money puts extraordinarily rich in terms of implied volatility. So the IV, okay, is through the roof, and those out of the money specifically puts at a 153 skew. So premium sellers, start your engines. People look at this and they say, premium selling's not that good right now. The VIX has dropped all the way back into what? The 17 handle. Yeah, that may be. Nevertheless, if you look at way out of the money puts, and I'll actually pull up the spider here for just a second. You're pulling up the spiders and you're looking at way out of the money puts. And let's actually switch this to implied volatility. Okay, there's juice out there for sure. You look at some far out of the money puts, we're talking like 37, even 40 volatility. And interestingly enough, for those of you that understand Ultima Premium selling, the further out you go in time, if you go out like 106 days, do you realize the skew is bigger out there? I mean, look at this. You got puts that are all the way what? $100, $150 out of the money. I mean, we're talking like 20 and 30% out of the money in the marketplace. Skews up like 40%. Implied volatility is phenomenal of far out of the money options at this point in time. Last but definitely not least, in this evening's update, I'd be remiss not to mention the bonds. What are they doing right now? I have no idea. The directional bias in the bonds, there isn't any real feel to this per se, and I'll tell you exactly why. There's some heavy bond volume. I mean, for a holiday week, bond traders, I mean, come on, they're worse than like equity and index traders. Bond traders typically do not show up for work during holiday weeks. I mean, the bond markets, they're worse than banker hours. Nevertheless, there's a big boy move inside of the bonds, and it's actually being done on significant volume. The reason it's perplexing is because when the bonds head down, all right, if you take a look at like TYX is the interest rate associated, rates will head to the upside, rates to the upside. But it's not actually helping financials. In fact, when I bring up the auto expected move, the financials are actually well short of the upper edge of the expected move. So what gives in this marketplace? Something has to give. If there's any more sell side activity in the bond market, you should see the XLF explode right up to the upper edge of the expected move. With that, and worth a mention, some weakness, if you will, out of Tesla, a little bit of weakness out of Nvidia. I'm actually surprised the S&Ps are just kind of meandering higher today because, Nvidia, right at the 300 level, it's a key inflection point. Watch this in the days to come. Nvidia could actually become, if you will, a catalyst again for a larger market move. With that, that's it, of course, for this Wednesday's update. A lot to think about. Again, premium sellers, kind of start your engines. We're at the upper edge of the expected move in the SPX. Volatility is dead. You're looking at this as holiday trade, but never count out the ability for volatility to come raging back, even inside the last 2 days of what is, if you will, a holiday trade of week. Thanks, everybody, and have a wonderful evening. Bye-bye.